Look at the way Hang Seng has moved. It is leading the gains in the Asian markets, up 2.1%.
A lot of uncertainty, disagreement about what will the Fed do and what should the Fed.
Hindustan Zinc has declared the fourth dividend, close to around 26 rupees.
Red 75 points higher, and it's a good start.
If all the shorts in the system have to be taken out, there can be a very good relief rally.
So board has approved the sell-off of 2,614 crores.
Chances are that they are likely to go with the board approval of around 233 crores of a buyback.
Autos are doing well. The Nifty Auto Index has a gain of close to about 0.7%, its largest ever order win at $160 million.
The company has spun off its last-mile mobility business into a new company.
We have started to put controls, systemic checks and balances, improved audit.
Nifty is up around 30 points. We also have the Bank Nifty, which is in line with the benchmark indices.
You're with us here on a fresh new edition of Closing Bell. We are coming to you from the CNBC-TV18 Motorola Oswal studios. I'm Prashant. With me, my colleagues Rima and Surbi here in the studios, and on the newsroom floor, Nigel, as always. Guys, hi, afternoon. Very, very quiet overall. Absolutely sort of going in very light in a way to that Fed meeting. I think that's what one has to say as one looks at the screen right now. The Nifty's got just 20 points now, and it's been that way. Just look at that. Just small change right from the morning on. I mean, the initial bounce got sold into, and after that, nothing at all. Not even a decent attempt at a big bounce or anything so far. Now, we are staying under the 17,180 level, which is a short-term kind of reversal level we've been waiting for the market to take out. So far, no luck. Let's see. Small caps, mid caps are doing better. And there are so many of these kind of individual stray names which are bouncing and shooting higher. Paytm, I looked at Imami, Sula, Uflex. Monte Carlo is up 20% in the last 3-4 days out of the blue. And of course, there is the Fed decision, which is later tonight. And I think reasonable to expect a 25 basis point hike. That is practically given. I mean, the market is giving a green light because market pricing is allowing a 20 basis point rate cut. And all likelihood, they will take it with a 25 basis point hike. The commentary, I think, beyond the 25 basis point hike itself will be very important. Will they stock in terms of, doing whatever? Will we see a ECB, Mario Draghi, whatever it takes kind of a moment from, Jerome Powell with regards to the U.S. banking issues? I think that's the big question. And of course, commentary on the rate trajectory from here on will be important. Those are the things we'll wake up to tomorrow morning. For now, it's flat with about a 26-25 point change. Rima.
Hi, and now that there is some calm in the financial market and it appears the storm has passed, the markets are once again pricing in the 25 basis points, rate hike. But had it been, say, 2 or 3 days ago when we were still in the eye of the storm, at that time, market expectations were for a pause. Just while coming down, I was listening to CNBC Europe. And they were just, highlighting to their viewers that what has the Fed done in the past 4 banking crises? And they go back all the way from 1966, which was the credit crunch. Then you had a continental Illinois collapse, which took place in 1984, go on to the peso crisis. And they're saying that there has actually been no uniform playbook. In one case, the Fed hiked. In one case, they paused. And in 2 events, they eased. So it's really, data dependent. And this is going to be one of the most anticipated FOMC decisions and perhaps the biggest one for Jerome Powell. But quickly, let's take our viewers through what's happening on the screen in terms of individual sectors. Insurance companies are having a good day. In fact, this week itself, HDFC Life, SBI Life have rallied close to about 4 to 5%. Reliance Industries is building on the strength from yesterday, so it's added on another 0.5%. But, in the banking pack, and that's what we've been talking about for a while, the picture is a bit mixed because private sector financials like Axis, Kotak, HDFC Bank are in the red, but PSU banks are holding up pretty firm. So whether it's State Bank of India, BOB, Bank of India, you can see that on your screen.
Oh, yes, absolutely. Just to your point on the Federal Reserve, whether they have a playbook or not, I think for now they have ECB. As a guiding example, because ECB had to come out with a rate decision the day banks were collapsing in Europe. I mean, the day Credit Suisse was falling 20-25%, and it seemed like all hell's breaking loose. And yet they kind of kept their head down, went ahead with that 50 basis points, and then reassured the markets that we're there in case it gets worse. So let's see. Anyway, Fed's an announcement that will come out later. The next 1 hour, what do we negotiate? Of course, Reliance is an interesting stock because now it's showing some traction. There's a 0.5% gain, as Rima also pointed out. But the problem is banking. By the way, TCS is also, these are some of the big boys, the blue chips that are trying to fight on the bull side today. Infosys is on the other side. So it's a little all over the place. But yes, the bigger question on the market is the problem with the banks. The Nifty bank continues to underperform again today. We had one decent day yesterday, and then because of this, you are seeing some weakness come in. The weight is coming in from HDFC Bank, as you can see. You've got SBI on the other side, ICICI on the other side, but HDFC Bank is really the biggest culprit from a bull standpoint as we see things right now. We will talk a little more about GAIL. Let's pull up the intraday because the absolute, the percentage gain is only 0.5%. See the intraday, that's the drama that played out. This is a significant tariff hike. I think about 45% is the tariff increase that they've got. They had asked for even more. So we'll bring in Sonal to, get into the nitty-gritties. But Nigel, I guess for the time being, absolutely flat, quiet, waiting to see what news we get at around 10:30 p.m., perhaps our time.
Well, indeed, Surbhi, it seems a bit of a wait and watch, and I think the Bulls will go home. I mean, 20, 25 points higher. They'll take it with both hands. I guess they'll even take a bit of a downtick in the final hour, because you're going into this event with no big rally of any sort. We've come off the lows that we saw a couple of sessions ago. Some consolidation, I think it's par for the course. The Nifty bank is struggling to move up actually today. The IT index is doing relatively better. But how do you position yourself in the final hour of trade? Mitesh Thakkar is with us. Well, Mitesh, what do you make of today's trading action? What are the stock picks you have for us?
So, Nigel, actually very quiet. It's like basically the market also hasn't been able to take a call on which direction it wants to move before the Fed event. So I think that's the kind of movement which is happening. Though I'm slightly positive given the fact that the intraday indicators have turned on the upside. And while we haven't had a decisive or a very conclusive move above 17,150, which is what I was observing, I think as long as we don't break 17,060 odd levels, I think I'll maintain a positive stance. And while it's not aggressive because of the impending event, but yeah, the overall bias is on the upside. And once we cross 17,150, then I think we should head towards that 17,280-300 zone. So mild positive view for the next couple of days is what I'm looking at. In line with that, I have two buy calls. In fact, Manappuram is something which is on the buy list. Here I would recommend going long with the stop just below levels of 116.5 for targets of around 127. And Jubilant Foods is the other one. It's actually started rallying a couple of days back, giving a good pullback. That's a buy with the stop at 443 for targets of 465.
Okay, thank you very much for that. Let's talk about GAIL. That's the stock grabbing headlines. The tariff of the integrated natural gas pipeline has been hiked. It's been hiked by 45%. Sonal is here with the details. Sonal.
Well, it was a much-awaited announcement, right? And it has finally come through. The expectation was of around 50% tariff hike on an average between 40 to 50% is what the analysts were expecting. So finally, PNGRB, that is the regulator, has gone ahead and hiked the tariff to 58.61 rupees per MMBTU, which is a 45% hike versus the current tariff. If we compare it with FY22 levels, it's slightly lower, but still, it is a hike nevertheless. PNGRB earlier had proposed a tariff of 60.9 rupees per MMBTU. After consultation and after an open house, they came to this particular number, that is $58.61 rupees per MMBTU. Now remember, GAIL had earlier in its paper asked for a hike of around 70%. But analysts on the street, and the street knew that that is not the number that's going to happen. They were expecting a hike between 40 to 50%. We had been discussing what could the possible impact on stock be because of this particular tariff hike. So CLSA had written a note on 6th of March where they had a target price of 125 rupees per share. They said they model a 40% hike, while a 52% hike, which the PNGRB had earlier spoken about, would boost FY24 EPS estimates by 7%. So analysts had an expectation that any hike between 40 to 50% would mean an EPS hike of 7 to 12%. That would come by, and that's why it's a positive. The stock is not reacting as much, one, because in anticipation of this hike, the stock had run up a lot, and this is slightly lower than expectation, but yes, that is not something that should worry the stock so much.
Okay, got that, Sonal. Thanks very much for the details there. Yeah, that explains why we got a cool off after that initial pop on GAIL. Let's take the conversation forward. GAIL and lots of other stocks to discuss today. We have Prakash Diwan joining in. Prakash, good afternoon. Well, it's a quiet, relaxed afternoon before we get ready for the action in the night. But I want to start with GAIL because of the inputs that Sonal was just sharing. It is a massive hike, right? 45%. Maybe not as much as what they wanted, but quite big. The only issue is the stock has run up in a year when the market's been, down 5%. GAIL's already up 10%. What's your thought on this one?
Good afternoon, Surbhi. So, yeah, I mean, I do understand that there is a feeling that GAIL has done very well in the recent past. It's run up. But actually, if you see, it's not still valued completely in terms of what the overall asset ownership it sits on. This price hike was something which people were more centered around, focused around, given the fact that it's a short-term impact and an immediate impact, right? And we've already seen that anticipation about a 10% hike in the EPS. But what's interesting is that the moment the GAIL assets start getting utilized for other things than just this particular thing, the gas idea, and then I'm alluding to the hydrogen possibility of hydrogen pilots being conducted for shipment of hydrogen gas. And if that were to kind of start working, there's no other solution provider with this kind of a scale and this kind of complexity. So, you need to look at it from a replacement cost basis, and you'll start believing that GAIL is fairly undervalued. And of course, there's a great dividend yield at play over here. It always rewards the government with a significant dividend. And even at this rate, the yields are fairly attractive. So I would believe this is more for the long-term investors, more for the, the long-only kind of funds. It's not something which is very exciting or very sexy. It doesn't move every day. Doesn't give you that kind of excitement on the charts. But yes, it's a great steady business to own if you're looking at an 8-10 year kind of a perspective, and if you have those kind of funds.
Prakash, stay with us. Let's just pull back a little bit to the broader market, right? Now, the recent underperformance of the market here has turned several sell-side brokerages tactically constructive on the market. Many are saying that this is a good time from where things should rally a little bit. Nimish is here with what they're saying. Nimish, over to you.
Thanks, Prashant. So as you rightly pointed out, it's a tactical constructive, so to speak, for the Indian markets, and there is a reason for it, right? We relatively underperform. The Nifty is down 7% and usually underperform the EMs as well as the DMs. So let me put out some notes which came today morning. So first is on CLSA. CLSA says that this is a contra buy time. That's the big statement coming in from CLSA. They believe that the sentiment is so extremely bearish that it's time to add beta to the India portfolio. Now they run their own bull bear index. Now that has reached 91% bearish level. This is what the report says, that it's come to 91% bearish levels, and that's the reason why. Barring few instances in 2008 and in 2020, they've seen such bearish instances 10 times in the last 15 years. And 9 out of 10 times, it has proved to be a good entry point into this market. So while I said, they're advising clients to add beta, so they've added a couple of names to their India portfolio. That includes names like Reliance, Hindalco, and IndusInd Bank, which have been the big underperformers starting this year. And they're replacing with Infosys, where they've taken an exit, as well as NTPC as well. So these two stocks have relatively outperformed as well. So that's a big call from CLSA. So on similar lines, even Citi has put out a note today morning, and they believe that the risk reward is turning favorable. And I'll tell you why. If you look at the numbers that they've put out, India has relatively underperformed this year. We are down 6-7% since the beginning of the year. If you compare to MSCI, India index, that has underperformed EM and DM both by almost 8% and 11% respectively. So we've seen a bit of underperformance, and valuations have turned attractive now. So CLSA note says that the valuations are now almost one standard deviation below the 5-year mean, and that actually turns out to be a good risk reward from an entry point of view. Even they run they have a sentiment indicator, and that is suggesting that it can give 1 year, at least mid returns in the next 1 year, and that has turned positive for the first time since June 2022. So again, the indicators are suggesting that because of the such bearishness, you might see a good entry and a bit of a tactical pullback rally. They have a Nifty target of 18,500 for March 2024. They've marginally cut down their multiples to 17.5 times, but still they are bullish from these levels. And even in their preferred list today, they've added 2 important stocks, which is Interglobe Aviation and GAIL. These are the 2 preferred stocks in the India portfolio of Citi. But the bottom line is, given the extreme pessimism and the sentiment for Indian markets and the fact that we've relatively underperformed, many brokerages are now feeling that this is a time for a tactical buy, and CLSA is calling a contra buy time at these levels.
All right. Nimish, thank you very much for that. And to boot, S. Narain, Executive Director and Chief Investment Officer at ICICI Prudential Asset Management Company, threw in his weight behind this tactical recovery, tactical rally call. Listen in to his views.
See, at 17,000 valuations are much more reasonable, and the global macro people are just too short on everything. And we have a Fed meeting today, and it is possible that there can be a good relief rally. If all the shorts in the system have to be taken out, there can be a very good relief rally. The global funds have just turned too negative at this point of time without reason, because they had to go short somewhere and they found India a good place to go short. So I think tactically we are very well positioned, but at the same time we don't believe in very big market rallies.
Okay, tactically well positioned. Till yesterday, the FIs were more than 90% short in the Indian markets. We were hoping for some sort of a short covering rally, but today at least markets are in a wait and watch approach. Some more stocks just pop out. Shobha Developers, that's down close to about 12.5% as the income tax department is conducting raids. So they've raided some of the premises and that sent the stock crashing down. On the gaining side, you've got Imami rallying 6.5% ahead of a board meeting where they will consider a buyback. And Sula Vineyards has got a thumbs up from CLSA. The stock is gained close to about 5%. But with the stock price at 355, it's exactly at its issue price of 357. So in the last 3 months, 3 months of listing, the stock hasn't given any sort of return. Prakash, is Sula Vineyards a stock that you like? Is it attractively positioned?
Rima, yes, it is. It is a very attractive business, and I mean, you can anticipate some premiumization to the valuations, given the fact that it's the only of its kind, right? But and I did hear the interaction that Mr. Samant had with you some time back, where he's talking about how well positioned they are, how resilient they are in terms of impact on grape prices and all that. But interestingly, it's a B2C brand which has still got enough headroom to grow. But the biggest competition that comes for it is from imported wines. We've not seen opening up of that particular sector in a big way. But you have a lot of these East European markets, a lot of the new age wines which are waiting to kind of flood Indian markets. And then there's just a little bit of tweak in the regulation that might make all that possible. So if that were to happen, Sula probably loses a lot of the mind share that it today sits on. But apart from that, I think it's a steady business. I don't expect any fireworks because they really don't have that pricing power as yet. In that space, and I don't know if Nigel is still connected, but we've spoken about how fast growing the beer market is. So within the wines and spirits segment, I think the beer market is going to be much more promising given the seasonality and the kind of preponderance of our consumption patterns. In that, I mean, wines is just 2%, whereas beer is 8% of the liquor market. So you already have a head start of sorts, and that's where a lot of things could happen to surprise us positively. So yeah, I do like the stock. It's owned by a lot of people, so I don't know really who else is wanting to buy it, and that's why the price the increase in the stock price might probably be a bit labored from here on.
All right, Prakash, and talking about beers, wow, 2:30 in the afternoon, market still open. You're talking about beers. Prakash, Som Distilleries, right? That's the one that you find valuation comfort, and we had the management as well. That's the one, right?
Yeah, okay. That's the one.
All right. What about the Vedanta Group? That can't go out of action, right? I'm just wondering now what happens from here on. Because till the start of this fiscal, Hindustan Zinc was sitting on a good cash balance of 20,000 crores odd. Now, all of that has been drained out. Piece by piece it's been drained out, and they've paid dividend of close to around 30,000 crores in this year. So all the cash generation as well has gone into dividend payout. And obviously that benefits Vedanta Limited and then Vedanta Resources. How would you approach Vedanta Limited from here on? I'm not talking about Hindustan Zinc because the float is very minimal, maybe 2.5% in the market. Vedanta Limited, how do you approach it?
So Nigel, today's turn of events is fairly interesting. I mean, it almost seems like Vedanta PLC Vedanta Resources ends up getting whatever it wanted to, at least a major part of the cash hoard that Hindustan Zinc was sitting. I think 7,000 crores comes its way, while the government also kind of goes home with about 3,000 crores. So in that sense, it's a very clear win for them, and it does help them at least shore up their balance sheet to some extent, where it's already been overburdened with a lot of leverage. Interestingly, the kind of composition of the businesses that Vedanta has, the listed entity in our case, is fairly poised for, interestingly poised for some sort of a growth trigger. I mean, you talk about metals, you talk about commodities, all of these, the way they rest into that, it could be promising. But the only problem with that business and that company and that stock is it kind of, hits you at times with surprises which are not very favorable. The kind of decision making of the management is not very minority shareholder friendly at times. And that's the reason why you discount it that way. But I think for the moment, they won the battle, if not the war, against leverage. So that's going to be a big respite for them.
Okay, do stay on. Need to slip into a very short break. On the other side, we'll invite our Alpha Manager for the day, Gautam Sinha Roy of ICICI Prudential Life Insurance. Stay tuned. Welcome back. Paytm is having a very strong session today. 5.5% rally on that. It's crossed its 20-day moving average, 50-day moving average, above that 600 handle on Paytm. And now it's approaching its 200-day moving average, which is 633. So moving up on very large volumes. JK Tyres, another one, 4.5% rally after the company secured about a $30 million or 240 crore investment from a marquee fund like IFC. So IFC has committed some money into JK Tyres' expansion plans, and the street is liking that move. Let's also talk about Bandhan Bank. That's surging in trade after the bank has approved the sale of the written-off portfolio and NPAs to an ARC. Abhishek gets us up to speed with the details. Abhishek.
Well, as you mentioned, Rima, Bandhan Bank's board has approved the sell-off of 2,614 crore, which is the written-off portfolio. It forms around 28% of the total write-offs that they have done in last 4 to 6 quarters, and about 2,316 crores, which is about 33.3% of the gross NPAs to ARC, that is Asset Reconstruction Company. So bank has received binding bid of 369 crore on their written-off portfolio and about 370 crores on their NPA in terms of security risk basis. So if you take a look, the recovery rate of 14.1% on the written-off portfolio and about 16% on the sale to ARC, these are good recovery rates, given the fact that if you take a look at the historical transaction this year that we have seen of MFI portfolios being sold to ARC, the recovery rate is around 5% to 10%, but over here we are getting a healthy recovery rate of 14% and 16%. And also the fact that they have appointed Ratan Kumar Kesh as Executive Director for 3 years. He had joined Axis Bank in his previous role in 2019 and has handled retail operations across liabilities, asset, credit card, etc. Back to you.
Abhishek, thanks very much for that. That's Bandhan. Prakash, we've discussed this name in the past. Any new thoughts? Bandhan Bank?
So as a matter of disclosure, I do have some exposure to this name. And Prashant, I would make it slightly generic. I think it's good tidings for this entire MFI pack. And we saw this happen to Equitas. It's happening to Bandhan. And if this continues for even a bit longer, it's going to be a complete U-turn for most of these companies, most of these businesses that have been struggling post the pandemic, slowdown. So I think the recovery rates are something which will make sure that they don't really add up more NPAs while the existing NPAs are written off assets actually come back and straight away go to the P&L. So I think it's a re-rating environment that's completely new to us. We've not seen that. We've seen this in PSU banks. This could probably happen to the MFI and small finance banks very, very soon. Yeah.
All right. Got that, Prakash. Good talking to you as always. You have a good middle of the week evening as you look out for the Fed, as we all will. And we'll catch you with the markets again soon.
Yeah.
All right. Well, the market's not doing anything. Just about 19 points up on the Nifty. Let's go across to our next guest on the show then. Gautam Sinha Roy, Executive Vice President and Fund Manager at ICICI Prudential Life Insurance. Gautam, thanks for joining in. We'll definitely talk about your portfolio and how you're looking at this market. But before that, a more general question. There's this big event that everyone's waiting for. This 25 basis points seems to be a given across markets. But what after? What happens tomorrow onwards? Right now, are you pricing in, maybe a sideways market, time correction at best, or do you think that we can probably get a bottom and start moving higher pretty soon?
No, thanks, Survi. Thanks for having me. I think the answer to that right now looks like we are in a sideways market with some upside in the near term because of the event in the evening today. And there are hopes of some talks about repivoting by the Fed sooner or later. So that's something that we are anticipating and looking forward to. Valuations are also reasonable at 17,000, no doubt about that. Plus the amount of FI selling that our market has absorbed over the last few months, if that were to reduce or that were to change, that itself creates a trigger in the near term.
All right. Hi, Gautam. Good afternoon. Nigel on this side. Gautam, how do you approach the markets, though? The headline index is down roughly around 10%, but stocks in the broader markets have got pummeled. Some of them are down 30%, 40%, 45% as well. You'll say we're at 17,000 odd. Some portfolios are feeling like 15,000. How would you allocate money from here on? Do you think that the broader markets now could, see a relative outperformance from these levels post the recent correction? Or given the kind of global setup, you still would allocate money to the large caps?
True, Nigel. So it's a bit of a quandary because, as you rightly pointed out, the upsetting factor here is the global situation where we do not know how that will swing. But having said that, as a deployer of long-term capital, do I like these markets? Probably yes, because I'm getting good stocks at reasonable valuations where growth outlook for the next 5 years is good. So from that perspective, I do like the market and the ability to deploy money at the current juncture.
So where, Gautam, are you deploying? Which sectors?
I think the standout sector where valuations are in your favor today is BFSI with, since before COVID, only 10% compounding in the banking index means that there has been no de-rating of the sector. Rather, some de-rating in select stocks have happened. Earnings are very strong. NIM is at a very high level. So we find great opportunity in the overall BFSI sector, particularly in the large banks. I would say the opportunities are very good today.
Gautam, in the large banks, one of your top holdings is HDFC Bank, which has been a relative underperformer versus its peers. Is there a reason for you to churn your holding in banking? Which ones, are likely to perform best from here on?
Yeah, unfortunately, Rima, can't get into very stock specific, but what has happened in banking is the dispersion in valuations, which was there 4 years back, that has narrowed. And now we see large banks to be more or less similarly valued, the private sector ones. And we see the growth opportunity to be equally good for many of them. So I would say that a basket of large banks and probably a select mid-cap banks to even some NBFCs would be a great construct to play this banking story. And this construct remains valid, especially given the fact that the overall credit growth environment is healthy. The Indian macro, as we say, is healthy. Even the micro is healthy. We are not seeing any troubles on the NPA side or anything like that happening. There's a infrastructure buildup which is happening. Capex is happening. Consumer loan demand is good. So from a 3-year perspective, is there an opportunity in banks and NBFCs, especially given the valuations? The answer is yes. And I think today, there is an opportunity which is quite diversified. So you have multiple banks which are looking quite attractive and even NBFCs which are looking attractive from a 3-year perspective.
Okay, so banks and NBFCs definitely get your thumbs up. Gautam, specifically, IT presents a pretty interesting dilemma, right? A lot of the large cap blue chip IT stocks are in a bear market. Infosys is down 25% from the peak. Wipro is down 40% from the peak. But the near term obviously is very muddled. So what is the approach you're taking? Is this the time to start accumulating IT for a medium term investor, or do you think it's too uncertain right now, so best to stay away?
Yeah, absolutely correct, Surbi. So the entire brunt of the global uncertainty is being borne by this sector, unfortunately. So we have a more neutralist stance in the sector, particularly given that valuations have corrected. And per se, many of these companies have done a fantastic job over the last 3-4 years. So two things. Overall, this is a very large sector, almost 13-14% in indices. So from an overall allocation perspective, we believe that even now we will remain neutralish till we get the clearer picture on the global side. And we are more focused on selection here, which stocks to play, because especially in IT, we have noticed that if you compare from pre-COVID to now, which is a very judicious comparison to do, we see that there is quite a bit of divergence in performance, be it in revenue growth, be in margin expansion, and hence in PAT growth for these companies. Capital allocation for all the large companies have been fantastic. There have been select mid-caps which have done remarkably well in terms of turning their business around and capturing the opportunity, the digital/cloud migration opportunity, which has presented itself over the last 3 years. So I think we have a decent set of companies identified there. And of course, as the global uncertainties recede and the picture becomes clearer, that will present an opportunity to add on to the holdings that we have in the sector.
All right, Gautam, how do you play the consumption story here in India? Would you look at staples, discretionary spends? That seems to be split down the middle. Rural India has been struggling, but now getting into an election year, the hope is that things improve from here on. However, you have suddenly this unseasonal rains that's probably come out of syllabus. What's your approach to the consumption space?
Yeah, so from a staples perspective, the margin benefits is definitely there. We have been hearing of early signs of pickup in even the rural or semi-urban demand, but the jury is still out in that. In the meanwhile, the urban part of the consumption universe, the discretionary part, is seeing some slowdown over the last few months. We have seen Q3 results. So it's a bit of a dilemma, and many of the stocks there are still quite expensive. So again, I think the approach here is similar. See, we do not want to forego of winning companies, great companies which have potential to create alpha over the long term. So we are lying low in terms of our allocation in some of these stocks. And as and when the macro environment turns more favorable, we'll probably go deeper into these companies and build larger positions. So that's the approach we are using, again, being stock selective and stock specific. So, but we believe obviously the opportunity over the next 5-10 years, the decadal opportunity in consumption doesn't even need to be discussed here. We are all aware of that. But there are near-term challenges, of course. There are challenges which can be overcome. Maybe in 6 months down the line, we might not be speaking of some of them, and some of them could be much more longer term. But we'll have to go by the how it plays out, essentially over the course of the next few quarters. But I'm sure that if one wants to build a good quality consumer portfolio today from a 3-5 year perspective, there is opportunity. Market is presenting that opportunity today because valuations are in your favor. And it's like, if you step back 2 years back, let's say, you were just chasing valuations, right? And today it's just the opposite. You are getting valuations that you're comfortable with. You can play the waiting game and get stocks at more reasonable valuations.
Gautam, I'm just looking at Sobha, which is down 13% now. That's a large cut for the largest Bangalore real estate developer. Any thoughts on? I know you stay away from naming names or talking about specific situations, but would you want to make an exception? Any thoughts at all?
Difficult, Prashant, but honestly, Bangalore real estate from a past 3-4 year perspective has been a spectacular performer. So with the IT hiring sort of slowing down, one of the questions that creeps into investors' minds is obviously whether that real estate cycle is in its last leg or not. But obviously, this is much more specific to that particular company than that. But if I had to generically look at Bangalore real estate, yes, 3-4 years back, pre-COVID, looked like a very interesting set of plays there. Valuations were again cheap. And that has played out. That has played out quite well. And today it might not. We'll have to revisit and really, decide whether the outlook of the next 3-4 years for Bangalore real estate is that bright. Jury is still out. We are probably debating that today, but that's what I would like to leave it with.
With today's fall, 13% fall on SOBA, we've basically come back to pre-COVID levels on SOBA. This is basically February of 2020, when SOBA was at about 430 or so. So we were
a lot
back
of value
there.
disruption. Yeah.
We're back there after. And of course, with SOBA, there is the IT raid as well, right? Which is, I think, of course, a trigger the near term, apart from what Gautam mentioned, which is the concerns with regards to layoffs, etc. Bangalore tech and tech professionals being the big market there for Bangalore real estate. Surbhi.
Just as we're thanking Gautam, I just want to check, Gautam, can you talk on your own sector? Suddenly become very hot in the market, life insurance.
Yeah, I think Surbhi, honestly, the biggest swing factor for a sector of late has been the regulatory outlook. Especially on the taxation side, and plus the other around the other regulations. So which way that swings is again the deciding factor from a very near-term perspective. So jury's out. Let's wait and watch how that plays out.
Okay, all right, Gautam. Always good hearing your thoughts. Thanks so much for stopping by and filling us in with those thoughts. We had a good chat today. Well, on that note, though, we'll slip into a short break. But as we do that, let's hear off Mr. S. Narain's top sectorial best.
Every one of the domestic funds and every one of the global funds has roughly 25-30% in banks. So if there is a redemption, people have to sell 25 to 30% banks. So till you see good inflows, banks don't perform, not because it is attractive and unattractive, but because it is a big holding in every fund. Of all the consumer discretionary stocks, this is one of the sectors where in the last 10 years there has been very low growth. So people don't put implied growth assumptions which are ridiculously high. So that makes the industry much more reasonably valued compared to many of the other consumer discretionary industries. Clearly, telecom is a sector where there is still scope for over a next 2 to 3 year period for ARPUs to grow from here. You can't predict when the ARPUs will go up. Aren't Indian ARPUs very low compared to the world? The answer is yes. Will they go up? They will go up. Can we predict the timing? Answer is no. The number of new age companies which are listed at this point of time are very few, and many of them have already made corporate governance mistakes. I must thank the first few listed companies in India for making mistakes, because otherwise we were very worried that they will come at absurd valuation. There has been a good fall in valuations of some of the first companies which got listed, which means that the following companies will have to come at much better valuations for the benefit of the mutual fund investors.
Welcome back. You're tuned in to Closing Bell, and we are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, it's that time of the day when Nimesh joins us to give us his sense about how things are panning out. Nimesh, big event coming up later tonight. But for the time being, the bulls are saying we are going in with some hopes. The market's still up 50 points odd.
I guess the hope is because there is a consensus now that there could be 25 basis points. So I guess that's the reason why some bit of bullishness. But overall, from a market's point of view, we are trending in a very narrow range. The volumes are on the lower side today. So there is lack of participation, largely because some of the banks are on holiday and are short. So within the FIs, again, it's a mixed day of trade, not much commitment on the either side, not large selling as well as not large buying as well. I guess two sectors stands out today. One is the insurance sector, largely on the back of some bit of buying interest back. For the second day running, we're seeing some bit of interest back, and those stocks are seeing a bit of upward momentum. Of course, they've underperformed a lot. So there is a bit of catch-up now, but there is genuine buying now coming in the insurance names from the larger institutions. That's the feedback. On the other side, the sector which is underperforming is the technology names. And even there, while the flows are mixed, but there is selective selling now in large cap names from the larger institutions. And I guess that's because of the fact that there's so much of fear with regards to the global banks. And that's where a couple of downgrades as well we've seen in this week. So from a supply point of view, that's where there is supply going on from the larger institutions. Net, we'll have to see what comes out in today's Fed outcome. I guess what Naren also pointed out, if there is no big negative surprise, you might see a bit of a relief rally. In the fact that you've been pointing out that there is so much of short in the system, a good news, and you'll see a bit of a short covering rally. that can help India markets to go up.
No negative surprise comes in later tonight, and those shorts in the system will actually be a blessing in disguise, because they could be forced to close out. But individual stocks, Nimesh, what are you picking up?
Well, a lot of blocks have changed hands today, so I couldn't capture all bit of it. But the first stock on my list today is M&M Financial. Again, there was a large block today, close to 80 lakh shares, more than 0.5% equity changing hands. And there, I believe, a large FI investor was a seller in today's block deal, so the disclosure will be important there. The second stock is Jindal. So after a long time, some bit of interest is back in this particular stock. So the volumes are on the higher side. The delivery is expected to be quite high today because there is genuine buying flow at a leading FI desk in Jindal Saw today. So that's the second one. The third stock is Krishna Medical. Again, a large block in Krishna Medical as well. Nearly 1.5% equity has changed hands. Looks like a private equity investor was a seller, and they've been a big seller for the last many quarters now, and they've been seller in today's trade as well. That's the overall feedback as far as the Krishna Medical block is concerned. And the last one is JK Cement. Looks like large part of the domestic selling is out of the way. So there was a large domestic mutual fund who was a seller in JK Cement, and that seems to be largely over, and hence a bit of a move there. But broadly, the feedback is in JK Cement, the large part of the domestic selling is out of the way.
Nimesh, thank you very much for that. Some of these other pharma names are pushing higher now. So Cipla is back in the green at the day's high, while Dr. Reddy's has rallied close to about 1.8%. And pull up the intraday chart of ICICI, and you would see a big swing in the stock price in the last 30 minutes. First the fall, and then the recovery. But ICICI Bank is now nudging towards a 1% gain. Mitesh is back with us for a few BTST calls. Now, Mitesh, you've been holding on to a positive buys. Any change in your holding? Any thoughts, based on what you've seen in the last 30 minutes?
I think the only good thing, Rima, is that the markets have, at least started to pick up. And with the intraday averages recording hourly on the hourly and the 2 hourly chart recording positive crossovers, I still believe that there's a better chance of us heading towards 17,280,300 to begin with, and in a best case scenario, 17,400, 450. So I think that's the outlook we have. On the stock side, I have a BTST on Page Industries. Keep a stop below 38,500 here. Look for targets of 38,950 on the upside. And while we have a lot of long positions and long calls given in the last few hours, I think one STBT call I would want to add is National Aluminium. Suggesting a STBT with a stop at 79 for targets of 76.5.
All right, got that, Mitesh. Thanks very much for the calls. Let's just get back to this move that we're seeing in the insurance space. And it's been building for the last couple of days. Today, a lot of the life insurance stocks are, of course, in focus, and they're trending higher. CLSA has written an interesting note on the sector overall. Surabhi is here with more details.
Life insurance sector has been in focus since the budget day, where they announced taxing high ticket size insurance policies. Now CLSA has written an extensive note on the sector, and they say the life insurance players have corrected anywhere between 7 to 24% since the budget announcement. They say that the current valuations factor in 0 to 4% growth in the medium term, and their own base case factors in only 5 to 10% growth in APE and VNB over the next 2 years, as opposed to 12 to 24% prior to the budget announcement. With all the negative priced in, they are upgrading SBI Life from outperform to buy with a target price of 1325, a sell to underperform on HDFC Life, where the target price is also raised to 500 from 460 earlier, and an underperform to buy for Max Financials, and they maintain the outperform rating on ICICI Pru with a target price of 485. For SBI Life, they say that it's least impacted with the budget announcement, and the low cost ratios and strong distributions remains their key strengths. For HDFC Life, they expect a faster increase in a wallet share from 58% to 70%, and that will offset the budget negatives. And for iPru and Max Financials, they haven't factored in any growth post FY25, and they say the promoter leverage for Max Financials still remains an overhang.
Surabhi, thanks very much for that. Insurance in focus. Now, Ambrish Baliga is joining in. There's about 13 minutes to go for market closing. This 50-point gain on the Nifty. Ambrish, let's not keep the best for the last. You have a stock pick, Bharat Forge. So why don't we attack that first? Tell us, why do you like that name? And yeah, go on.
So Bharat Forge clearly is among the leading auto component exporters with a strong engineering technological competencies in forging as well as metallurgy. So they have the user industries across such as passenger vehicles, commercial vehicles, oil and gas, construction and mining, power, which also now includes renewables after their recent acquisition, and they are decently large in defense also. So nearly about 47% of the revenue is from industrials. And if you see the last quarter results, they were decent. I wouldn't say they were excellent, but they were decent numbers. EBITDA margins increased about 310 basis points. And if you look at the demand, it's quite robust as far as passenger vehicles, commercial vehicles in the defense space is concerned. And now they are focusing on EV space, having invested in a premium two-wheeler EV bikes startup. And also in UK, they have invested in EV commercial vehicle company Teva Motors. And Bharat Forge has in-house powertrain solutions, which again is a prime piece in the whole EV chain. If you're talking of defense, they have presence in artillery systems as well as protected armored vehicles. In aerospace, they manufacture jet engine components, sub-assemblies, and structural items. And these two verticals, that is defense as well as aerospace, could actually see exponential growth if you're talking of the next 4 to 5 years. So overall, I'm expecting the revenues to grow at about 18% CAGR for the next 3 years. And we should remember that the last 4-5 years hasn't been too great for Bharat Forge. So the next 3 years, I think the growth will actually stand out. And with this, I'm expecting EPS of about in FY25 of about 35. So my target is about 1,050.
Okay, 1,050 on Bharat Forge. So that's a bullish call coming in. Amrish, hi, good afternoon. I don't know if you could hear our colleague just talk about this, report on life insurance stocks. CNSE seems to be turning a little optimistic. There's an argument there, obviously, because the stocks have underperformed so badly. But the question is whether there'll be growth and what the current prices are really factoring in. Would you be a buyer in any of these stocks?
In fact, I've been a buyer for the last 6 months, although we've seen the stocks coming down, and especially post-budget, because of the 5 lakh plus policy issue, we had a decent correction. But I see that as a buying opportunity because whatever said and done, financial literacy is increasing, and life insurance is still an under-penetrated sector. And because of the sort of corrections which you have seen, at these levels, the valuations are quite mouth-watering. And again, you require that waiting period for the next at least 3 to 5 years. And I'll not be surprised if we see some of them actually becoming multi-baggers. For example, something like a SBI Life or a HDFC Life can easily become multi-baggers from here.
Hi, Amrish. Good afternoon. Amrish, what about VST Tillers? That's been touted as one of those big value creators for the last many years. But it's still actually to live up to potential. Earlier, it was just VST Tillers. Then they introduced the tractors. Everyone got quite excited out there. But they have managed to sell less than 30% of their capacity. What's your view on the stock? Do you think its time has come?
No, I mean, see, like they always had that unique position because of the sort of, the small capacity tractors and tillers which they had, because of which they had that niche sort of a space. But then only thing which I'm worried about right now, as far as this space is concerned, is the El Nino effect. I think we'll have to wait for another month or two to understand whether because of that we could have a poor monsoon. If that happens, I think the whole farm story goes for a toss. So because of which, in fact, at this point of time, I'll not go out and buy. I'll possibly wait for an outcome. Maybe in the next month and a half, 2 months, we should exactly know as to where we stand as far as El Nino is concerned, point,
Amrish, do you look at Shobha Developers? Would you be very worried about the tax rates taking place at their premises? Or do you think this decline in the stock, 13%, is actually an opportunity to buy?
No, I think any other incident which happens, which is business related, which is negative, possibly could be an opportunity to buy. But if it's a tax raid, I think one should be worried. So I will not really touch Shobha at this point of time, although I had suggested buying Shobha about 2 years back. But then because of this rate, I would possibly wait for a while. I'll not jump in and buy right now.
Okay, got that. Well, Amrish, thank you. Keeping it a little short today, and we look forward to our next conversation. But thank you for joining in with your specific take on some of the stocks that we've discussed. Markets up 46, and it's not at the day's high, but it is looking to go home with some modest gains as we get into the big event. Quick break. We'll come back with a close on the other side. Welcome back. Just about 3.5 minutes to go before closing out. So let's listen to some more opinion that we got from S. Narain today. He says that we're no longer in a high return environment. Take a look.
Trouble telling investors, 2008 to 2021, you had printing presses in Washington and Brussels. Even now, printing presses are on in Tokyo. So you have to look at valuations in the next 5 years. You have to take a call whether the printing presses in Washington and Brussels will again reopen or not. If the printing presses in Washington and Brussels will not reopen, you can't put the last 10 years valuations all the time, because at that point of time you got zero in debt. And because you got zero in debt, people invested in equity. So should you use the last 10 years valuations or not? That's why when I tell investors you can't get 15% per annum easily in equity, people start looking at me as though I'm a bear. I'm not a bear, but I'm a believer in more moderate equity returns, because you don't have printing presses operating in Washington and Brussels. You're not in a high return equity world, because 2008 to 21 was backed by record printing in Washington and Brussels, and every Indian corporate which was credit worthy could get money in global markets at less than 1%. Today, when they want to borrow in global markets, they have to pay 5 to 6%. That's a big change. And that change people don't want to understand. And that is why big returns in equity market require much lower interest rates in the Western world.
Okay, and that is what we want, lower interest rates. And then we are going into the Fed decision later. I don't think we will get lower interest rates, but we perhaps will get a smaller hike later, much into the midnight. Surabhi, of course, will be awake tracking all of it.
This is one of those rare meetings where people are saying, go ahead and hike. If they get lower interest rates today, then there's a problem. Then the market will probably get really nervous. Weird times we live in.
All right, we'll, for today, by the way, the market is up, 40 points. 17,150 is where we are ending. Banks doing decently okay. Pharma, PSU banks and small caps are sectors which showed some gains. I mean, the other one is what was down was the government pack. I mean, so CPSE as an index was lower, the only prominent one which was down. Financials, not banks, but I mean others did quite okay as far as the nifty stocks are concerned. I'm talking about names like HDFC Life, Bajaj Finance, Bajaj Finserv, SBI Life, and so on and so forth. Rima.
Well, we managed to trade in the green through the course of the trading session, but by the end of it, up about 0.25%. To drill it down to individual names, life insurance companies did well. HDFC Life, top honors, 3% gain. Also strength coming in SBI Life. For the week, these stocks have rallied 4 to 5%. Bajaj Finance, Bajaj Finserv also showing you some strength. Pharmaceutical names made quite the comeback. So Sun Pharma, Dr. Reddy's and Cipla. Cipla, of course, modest gains, but Sun Pharma 1.5%, Dr. Reddy's up 1.25%. ICICI Bank also made a big up move. On the losing side, BPCL comes in for profit taking. Like yesterday, Adani Ports under pressure, and a few FMCG names like Nestle Britannia and a couple of private sector banks like Axis and HDFC Bank also lower.
Yes, that's the large cap screen. Mid-caps, just want to point out Sobha because of this IT issue, income tax searches or raids, call them what you want. 13% down on the stock over there today. In terms of major movers, Paytm had a good session, 6.5% higher. Imami, markets excited about a buyback, so about 6% on Imami as well. Uflex, 6% higher. So there was a fair amount of stock picking going on, but at a headline level, the mid-cap index has ended with just a 0.25% increase. Well, that's the market as we get into the Fed event. Quiet, steady, waiting to see the outcome.
Okay, with that, we're going to wrap up on Closing Bell. Don't go anywhere. Catch our full conversation with S. Narain of ICICI Prudential AMC on the other side on our special show, Market Masters.